By the time the annual review came around, the race had already been entered into payroll. The conversation was calm, structured, and familiar. A 3% adjustment, standard across the department, consistent with company performance. He nodded, signed the digital acknowledgement later that afternoon, and closed the laptop in his home office before walking into the kitchen where the dishwasher hummed against the quiet. At 42, his career looked stable from every visible angle. 15 years at the same corporation, senior title, managed a team of 8, performance ratings rarely dipped below expectations, health insurance premiums deducted automatically, retirement contributions flowing every 2 weeks into a target date fund he selected years earlier and never revisited. A modest but well kept suburban home purchased in his early 30s. 2 children in public school. One car paid off, the other halfway through its loan term. Stability had been the point. In his late 20s, he had watched friends jump between companies chasing larger offers, sometimes relocating across states. He stayed. He valued predictable income over negotiation cycles. He valued steady health coverage over uncertainty. The company matched his retirement contributions up to a percentage that seemed generous at the time. Promotions came slowly but regularly enough to feel like forward motion. Each raise felt incremental but safe. The first few years, increases outpaced his rent. Later, they roughly matched inflation. Eventually, they fell slightly behind it. It didn't register immediately because the numbers were close. A 1% gap is hard to fill in a single year. It compounds quietly. His base salary in his early 30s had seemed substantial compared to his starting pay out of college. When he bought the house, the mortgage payment represented about 26% of his gross income. That ratio felt responsible. Taxes, insurance, utilities, and childcare still fit into the remaining portion with careful budgeting. Vacations were domestic. Retirement contributions were automatic. The emergency fund held 6 months of expenses in a high yield savings account that no longer felt especially high. He told himself the system was working. The first subtle shift came during a year when company wide raises were kept. Corporate earnings had dipped slightly, though not catastrophically. Executive leadership cited market pressures and long term competitiveness. The 3% became 2. The following year, it returned to 3. The pattern normalized. Meanwhile, property taxes rose steadily. Home insurance premiums ticked upward. Groceries crept higher. Gasoline fluctuated. Health insurance deductibles adjusted quietly during benefits enrollment season. He noticed the credit card balance took longer to pay off each month, even though spending patterns hadn't changed dramatically. Nothing extravagant had entered their lives. No luxury purchases, no second home, no private school tuition. Just incremental cost increases that didn't ask permission. He remained loyal to the company. He trained younger employees who arrived with higher starting salaries than he had earned at comparable stages. Some left within 2 years for larger pay increases elsewhere. When exit interviews circulated through management summaries, compensation was often cited as a factor. He absorbed additional responsibilities when roles went unfilled. The realization did not arrive dramatically. It surfaced during a benefits portal review late one evening. He was examining his retirement account balance after a volatile market quarter. The total seemed large in isolation. 6 figures, a number that would have felt unimaginable in his 20s. But projected retirement income, calculated using conservative assumptions, replaced confidence with math. The estimate suggested a replacement rate lower than he expected. Combined with Social Security projections, It indicated a retirement lifestyle slightly below his current standard of living. He recalculated with a modestly higher annual return assumption. The projection improved, but not dramatically. He increased his contribution percentage by 1 point and watched his next paycheck shrink slightly. It was manageable. It always had been manageable. His salary had grown in absolute terms over the years. From the outside, it looked like a steady upward climb. But adjusted for inflation, housing costs, healthcare premiums, and educational savings contributions, the slope flattened. He compared his compensation growth to national wage data out of curiosity one weekend. His experience wasn't unusual. Many mid career professionals saw compensation plateau after early career acceleration. Merit increases hovered in narrow bands. Promotions required either relocation or vacancy above. Organizational structures limited upward mobility. He had opted for geographic stability. The company's headquarters were within commuting distance of the house they purchased. The children had grown up in the same school district. His spouse had built her own career locally. Extended family lived within a few hours' drive. Mobility carried costs beyond salary. At 45, he reviewed his pay stubs from a decade earlier. The gross number had increased by roughly 20% over 10 years. During that same period, healthcare premiums had nearly doubled. Property taxes had risen consistently. The cost of replacing the roof, which they postponed once, came in higher than expected due to material and labor increases. The math was not catastrophic. It was narrowing. In meetings with his team, he encouraged professional development, certifications, cross-functional exposure, visibility to senior leadership. He believed in career progression. He had built his own path incrementally, but he also understood the structural limits. Annual raise pools were allocated centrally. Promotion slots were finite. Budget approvals required justification. He did not resent the system. He had chosen it. In his early 30s, he declined an external offer that would have increased his salary by nearly 15%, but required relocation to another state. The timing felt wrong. They had just purchased the house. His spouse was pregnant with their first child. The offer included performance-based bonuses that were not guaranteed. He stayed. The decision appeared rational then. It still appeared rational on paper. Yet, he began to notice that external hires continued to reset compensation bands in ways internal raises rarely achieved. Colleagues who left and later returned sometimes re-entered at higher pay levels than if they had remained continuously employed. His loyalty did not translate into accelerated compensation growth. It translated into predictability. Predictability reduced stress. It also limited upside. By his late 40s, college savings contributions intensified. Tuition projections for in-state public universities exceeded what he had paid for his own education, even adjusted for inflation. He had started 529 plans when each child was born. Market gains helped. So did automatic monthly deposits. But projected 4-year costs still outpaced the balances unless additional contributions were made. He adjusted again, reduced discretionary spending slightly, deferred the kitchen renovation, increased automated transfers to the education accounts. Retirement contributions remained steady but not aggressive. Performance reviews continued in the same pattern, 3%, occasionally 2.5%. 1 year, 4% following a strong departmental performance cycle. Bonuses fluctuated modestly, but never dramatically. He noticed that the ratio of fixed expenses to net income crept upward. Not sharply, not alarmingly, but enough that flexibility narrowed. The margin that once absorbed unexpected car repairs or medical bills with minimal disruption now required more deliberate planning. His house appreciated in value over the years. Online estimates showed steady growth. Equity accumulated, but equity was illiquid. Accessing it required refinancing, a home equity loan, or selling. He did none of those. The house remained their primary residence. Its appreciation existed mostly as a number on a screen. During a company restructuring in his late 40s, several mid level managers were offered voluntary separation packages. He was not included in the first wave. Later rounds targeted different divisions. He remained employed, but the atmosphere shifted. Long tenured employees began updating resumes quietly. He considered what his market value might be externally. Job postings for similar roles listed salary ranges that overlap with his current compensation, sometimes exceeding it slightly. But they also required new performance cycles, new internal politics, new benefit structures. He weighed stability against potential incremental increases. The calculus no longer felt simple. At 50, his retirement account balance crossed another milestone. The number appeared substantial. Yet he calculated what sustained withdrawals might look like over 25 or 30 years of retirement. Healthcare costs in retirement remained a variable he could not fully quantify. Long-term care insurance premiums, which he explored briefly, added another potential line item. His income had grown consistently for 2 decades. It simply had not grown fast enough to create wide financial latitude. He paid off the second car loan. That improved monthly cash flow modestly. The mortgage balance declined gradually, though property taxes offset some of that relief. Home maintenance costs appeared with predictable unpredictability. HVAC replacement, appliance repairs, exterior painting. Each event was manageable. The pattern was cumulative. Looking back, he recognized that early career salary jumps often occur in the first 10 years. After that, growth frequently slows unless accompanied by significant role changes or industry shifts. He had valued continuity over acceleration. The trade-off surfaced slowly, not as crisis, but as compression. His peers' experiences varied. Some who pursued aggressive job hopping achieved higher compensation, but also experienced layoffs during downturns. Others moved into consulting roles with variable income streams. A few transitioned into executive tracks with substantial bonuses tied to performance metrics he never pursued. He remained in a middle band, secure, experienced, trusted, moderately compensated. The children approached college age. Financial aid calculations incorporated income and assets in ways that reduced eligibility. His responsible saving diminished need-based assistance. Merit-based scholarships remained uncertain. He increased cash reserves temporarily to prepare for tuition payments. Retirement contributions held steady but did not increase further. The flattening did not erase decades of responsible financial behavior. It narrowed optionality. At 52, during another annual review cycle, the raise percentage matched prior years. Inflation that year exceeded it. The difference was noticeable in household budgeting spreadsheets he maintained out of habit. Groceries required a higher monthly allocation. Utility costs reflected broader energy trends. Insurance premiums adjusted upward again. He did not experience panic. He experienced recalibration. The long-term consequence of staying in one stable corporate role was not dramatic loss. It was gradual containment. Compensation growth that once felt expensive became incremental. Fixed costs that once felt proportionate grew relatively heavier. He owned a home with equity. He had retirement savings that would likely support a modest lifestyle. His children would attend college with partial savings and some student loans. Health insurance continued. Employment remained steady. He had done what many considered responsible. He avoided excessive debt. He contributed to retirement consistently. He stayed employed through economic cycles. He prioritized family stability. The realization arrived not as regret, but as recognition. Stability preserves. It does not necessarily compound. In quiet moments at his dining table, after reviewing account balances, he sometimes compared his current net worth to hypothetical projections had his compensation grown slightly faster over the past 15 years. Small percentage differences, compounded annually, produced meaningful divergence over time. But those projections existed only in spreadsheets. Tomorrow, payroll would process as scheduled. The same percentage contribution would flow into retirement. The same insurance deductions would apply. The same mortgage payment would clear. The system continued functioning. He closed the laptop again, not dissatisfied, not triumphant. The path he chose had carried him forward steadily. It had simply narrowed as the years accumulated, compressing possibility into predictability, and predictability into something quieter than growth.